So some number comparison in these two businesses which I am trying to read, not we are trying to read. So been reading basically all the annual reports as from 2009 of plastic bands and Potar and all credit rating reports. तो मोटा मोटा धंधा सिंपल है कि दे आर मेकिंग डिफरेंट टाइप्स ऑफ मास्टर फाइबर्स, मास्टर बैचेस. Plastic bands is making master batches, say white, black, and colored, which are a key component into making plastic furniture or plastic equipment, and they are supplying to n number of customers, maybe Reliance also, and Supreme Industries also, and क्या नाम है, नील कमल also, and many kind of businesses. They are basically, these products are mixed with pigments, and they give color, and they give cost effectiveness, and they are help to making your plastics, which did run up during the time of COVID, and because of PPE kits, because of masks, because of gloves, and all those kind of things. But these are very two similar businesses. They are also into making fibers. They are not in that, very similar businesses. So I can see the plastic pens has a much bigger business than Podar, basically double the sales. But Podar, if I see from COVID, has not been able to even come back to pre-COVID levels. So the sales have not crossed back from maybe 2019-20, and the sales are very lackluster and sluggish. In fact, their profits have climbed up to 38 crores, which is the EBITDA margins or EBIT profits, with the fluctuation of OPM, which is not very constant, basically because they have been able to better source their raw materials. That is the case. They have not been able to grow the business, whereas Plastic Bands has been able to grow the business by from around tad bit of 600 crore sales now at around 800 crore sales, and they have been losing on gross margins. So maybe the products or the things they are making, and if you go and read in this annual reports, you will get to see they say we have changed the product mix, they keep talking about product mix, but the numbers are not showing that. But in cyclicals, see, in this last 4-5 years, when they had crossed 500 crores of sales, their lowest OPM is 50 crores, and you have the lowest price earnings multiple of 6 times. So anyway, between 6-7 times and a maximum level of say 15-16 times or 17 times trailing numbers is where the cyclical range of the business is. So today if I go and see, this is Podar pigments, this is Plastic Bands. Today if I go and see, the P ratio is around 25. Does it make sense? It is coming down from 13. It does not make any sense to buy this company where the earnings multiple are at the higher end of the range, which have crossed all these kind of ranges. 300 rupees stock price was in TTM. Today the stock price 304 rupees. But this is trailing number. Now I don't see you can go and buy at a price of 15, 16, 17, 20. But in cyclicals, why would these profits collapse? Definitely because of the raw materials expenses going up. See, my raw material expenses going up and my profitability going down, my P going down to 9 is a lower end of the range. But why my stock price has not moved up, rather moved down in spite of the sales going up? Because I am losing on margins. Two things to note: are these my peak margins or are these my base margins? These are the lowest margins this business has had in the last so many years. These are the lowest margin this business has had in the last so many years. They went down to 20% also. So approximately, if I see last few years in both the businesses, 20 to 22% are the lowest margins, 28% are the highest margins. Now they have reached to 30-31% in at the gross margins level. So when you have a lowest margins and you have a lowest price earning multiple, which is this the case, you have a scope for a re-rating, because if the margins change again, you have a scope for re-rating. See, the stock price doubled in no time, 2-3 quarters. So did the numbers change? Let's go and look at the quarterly numbers. This is Q1. 22% gross margins we are coming here over. Let's try and calculate our Gross margins over here. What are the gross margins over here? So it's 145.98 plus 2.33 divide by 195.66 minus 1. Gross margin 24% over here in Q1. Next, gross margin in Q2. 159.97 plus 0.14 divide by 210.45, again 24% margin. So you see the trend of the gross margins in a quarterly numbers, which we can also calculate from our quarterly sheet, but do it manually to understand what is actually happening. The trend of the gross margins, which is here 24%, 24%, 24%, will give us a clue. What is the clue? The gross margins are reverting back, and why the stock price has gone up in the last, say, 3 quarters or so, mainly because of earnings multiple expansion. You have had a doubler. See, these are not sustainable things. These are cyclicals, these are methods, these are snippets, these are ways how do you play out cyclicals. How play is not a good word. How do you try and time cyclicals and make a quick buck out of it, maybe in a matter of few months, and get out of it. So this is a way why I'm reading on these businesses, because of the cyclicality of the nature. Currently 31% margin, 24% margin. No, I want to get down to this condition, and I want this condition to help me get to a lower end of the range, and that is how I can see if the margins are reverting back and I'm at the lower end of the range. That is the time to go and buy cyclicals. And when do you get to lower end of the range? When the numbers are not very enticing, the numbers are bad. Okay.